All right. Good morning or good afternoon, Noble Gold fans. Thanks for tuning in. It's Tuesday, November 4th, and we'll cover a few different things today. I'd like to go over what we're hearing a lot about in the news with respect to AI, job cuts, people being replaced all over the place. Lots of different jobs are getting, or they're coming, AI is coming for a lot of different jobs, I should say. Seems like nobody's safe. Lawyers, taxi drivers, etc. Everything in between. So we'll just chat about a few different things here. Headlines are calling it a AI earthquake, and why 300 million workers might be replaced by 2030. It's not a small number. That's globally, of course. That's almost every single person in the US. So globally, I mean, these are huge, huge numbers. Um, and there's some interesting facts and talking points. So, white collar vulnerability um, used to be able to say that certain jobs were safe. Office administrators, lawyers, and paralegals, architects, and engineers. All these white collar jobs that were previously kind of a shoe in for a nice long career, no longer the case. And it's not just that; it's also kind of bottom end, front of line, service people. All these various jobs are at risk of getting replaced. Now, we see these headlines about job cuts. This is sort of feeding into this. It's also sort of feeding into the AI frenzy, the bubble that we've got in AI stocks. And I'll talk about that a little bit more in a second. But we've seen over 100,000 layoffs just in the last 2 months, really coming back from summer. UPS slashing 48,000 jobs. Amazon, 14,000 jobs. Target, 1,800 jobs. And, we're starting to see again this stuff pile up. It's adding maybe to the economic concerns in the shorter term. Why the Fed cut rates last week. This is very likely all feeding into it. So, on one hand, you've got a booming stock market. AI stocks are, other than today, they're actually correcting and down a little bit today. Again, we'll talk about what I expect to happen there. But the last several months, the trend has been significantly higher prices in AI stocks in the NASDAQ, NVIDIA, OpenAI. And so that's all good for people's 401ks, at least for now. But it's been actually pretty bad on the job front as far as employment numbers and statistics go. So if we see this trend continue or pick up steam, I think we could probably see a more dovish Fed. Like maybe they get worried that in the short term, we're losing too many jobs, even though in the long term, productivity is expected to go up through AI and innovations in productivity and what have you. But my take, again, just my opinion, is the AI stuff we're seeing, it's real. People are really going to lose their jobs. That part is probably something we can't do much about. It could be slow rolled, perhaps, and I think that probably will be the case. But there's such fervor and mania and hype around the AI sector that first we probably have to have the AI tech bubble, AI stock bubble pop first. And I'd liken it to 2000 with respect to the NASDAQ and all the dot com stocks. In 1997, 1998, 1999, if you had a dot com business, it surged on the public markets. They went ballistic. They were trading at 40, 50 times earnings, much like we're seeing now with some of these AI companies, and in some cases, even higher. And they weren't wrong that the internet at that time would change the world. Of course, it has. It's changed the way that we do business. It's changed the way that everyone even operates from a day to day basis. The internet was probably the biggest life changing technological advancement at that time. And it has had a real world impact since then over the last 20, 25 years. The thing is that those impacts weren't necessarily implemented to the benefit of everybody right away. So essentially, the Nasdaq and all the dot com stocks priced in all of the advancement, all the changes, and all the refinements and improvements that it would have, you know, way too early, right? So you had an 85% crash in the Nasdaq from 2000 to 2001. And then what people don't remember is that we had a lost decade, more than a decade in the Nasdaq. The Nasdaq did nothing. For over 10 years, it went sideways and downward. And it wasn't until 2013 or 2014 that we had recouped and regained the previous high that was hit in 2000. So, will we see similarities in AI? Will it change the world? Will it change the way that everything functions? Yeah, and especially it changes, the world for those who are losing their jobs in the immediate term. But my opinion is that the hype around these stocks will probably let out sometime over the next year, and you could see a correction in the Nasdaq 30, 40, 50 plus percent, very, very similar to a dot com style bust. And maybe they do nothing and the index does nothing for the next 5, 10 years, similar to the post.com crash. That I don't know. I guess time will tell. Pin this if you want, hold it against me. But I think we're quarters away or a year away from something like that. It's not, around the corner, but it's probably sometime in the next year. Gravity will kick in on these AI stocks. That stuff will still change the landscape of the workforce and our economy, but it'll be still many years before it's really doing that in full force, like we've seen with the internet since 2000. Okay, and so to kind of turn this around and to go to a different topic, I'd like to talk about shortages in silver. So we see this talked about a ton. Some of it's hyperbole, some of it is real, but there are actual supply constraints to the physical silver market. Now, I would say there's a couple of camps that you can find people in. You can find that there are sensationalists. Get your silver now or you'll never get it. And also, there are some that want you to believe that there is no physical shortage of the metal at all. The position I take on most things is just fact based, trying to be a little bit more balanced in the information that we provide. I do believe that we will be entering a world where silver is unobtainium. Jokingly, I refer to that instead of it being an available element on the periodic table, it'll be completely unavailable and unobtainium. Now, I don't think that that's too far off. It might be a couple of years from now. We've certainly seen periods in high demand where we have very little physical silver to offer. We're not there right now, but we could be approaching that in the next several months if this type of pace in terms of our inventory depletion and our buyers coming in to buy the dip that we've seen over the last couple of weeks. If that continues, we very well could see some tightness in our inventory here at Noble Gold. But as of late, no major impacts. Nothing there to really talk about. But why is silver potentially a lot less available than what's believed? And I'll walk you through some of the numbers just in terms of where we're at. So right now, 70% of all the silver that's mined comes from a byproduct of base metal mining, meaning copper, nickel, zinc, these metals that other mining companies are pulling out of the ground. They find silver along the way and they separate it all. They sell the silver onto the market, but it's not a primary source. There are some pure silver mines and pure silver mining plays where their deposit is mostly silver, but that's very much the minority of supply is coming from pure silver plays. It's rather a byproduct from all this base metal mining. Now, if 70% of all that comes from base metal mining, 30% comes from direct gold and silver mining, then it's really the smaller piece of the pie with respect to the supply formula. But on the demand side, we know that, let's just call it roughly 60% of all the silver that's mined actually goes toward industrial consumption. And industrial consumption of silver includes Solar power, of course, new solid state batteries, which use 30 times the amount of silver than the old EV batteries. So they went from using an ounce to a kilogram, which is actually 32.15 ounces, troy ounces. Solar being the biggest, solid state batteries is another. But silver's got antibacterial properties. It's used in clothing. They thread it into Lululemon so that your clothing doesn't stink. They add it to water filtration systems because it's actually a water purifier. Um, Funny, just an old, I can actually remember this from high school, an old project that I did to actually prove the antibacterial properties of silver is you put a glass of milk on a counter, one with an ounce of silver in it and one with not. And you determine the time that it takes for that milk to basically sour and curdle. And you'll actually get like 5 times the length of freshness. So it can go almost a week. With the silver coin in it. So interestingly, it's used in stuff like that. But so 60%, back to the numbers, 60% of what's mined goes to industrial. Now, the Silver Institute, this stat's a little bit dated, but that number is expected to grow by 80% over the next 5 to 10 years. So an 80% growth of already 60% would put you at a total of 90% industrial consumption of all the silver that's mined. That's where we're going. That's why it will be a very, very, very tight physical silver market. Now, the balance from today's numbers of 60 being produced for industrial and 40 being produced for ornamental and monetary purposes, like the bullion that we sell to our clients. And so that's really not a lot. In the grand scheme of things, about 800 million ounces every year is the total. Now we have some ratios that I'd like to go over, which kind of put into perspective the actual scarcity and the price potential that we could see in silver because of this stuff. And so the mining supply ratio, this is a very important one. The mining supply ratio, which means how much gold comes out of the ground for every ounce, how much silver comes out of the ground for every ounce of gold, and that number is an 8-to-1 ratio. So 8 ounces of silver comes out of the ground for every 1 ounce of gold. Now, what is the current price ratio today? Based on this chart, we're looking at an 80. Let's call it 283 to 1. So they come out of the ground at an 8-to-1 ratio, but they're technically still priced at an 83 to 1. Well, let's just go through what I laid out for us. Half of that we'll round it down at 60%, but we'll just make the math easy for us. So 8 ounces of silver come out of the ground for every 1 ounce of gold. Well, half of that goes to industrial, half of that goes to monetary consumption. So you've got 4 ounces of silver for every 1 ounce of gold that's available for investors through the form of bullion or monetary silver. So they're really only available, if we use those quick math numbers, they're really only available at a 4-to-1 ratio, okay, in terms of the actual stock of silver for investment purposes. But they're priced at an 83 to 1. Okay, so something's wrong, right? There's the price ratios suggest there's way more silver than there actually is, especially for this purpose of monetary investment. And so my thesis for a long time, 8 or 9 years now, and I own mostly silver myself. About 90% of my total precious metals portfolio is silver, a little bit of gold, a little bit of platinum, but I'm banking on a reversion to the mean for the gold to silver ratio. And if we pull that chart back up, what this suggests to me is if it's only coming out of the ground at an 8-to-1, there's really only 4-to-1 available for bullion or investor purposes, then the price of 83 to 1 is wrong. Now, I'm not suggesting we're going to a 4-to-1 price ratio, but my view is that we'll at least return to the low from the previous major precious metals bull market, which was from 2008 to 2011. So 2008, what happened? The global financial crisis, stocks crashed by 50%. Gold and silver became a safe haven and a lifeboat for investors globally. The amount of capital that poured into gold and silver during the great financial crisis shot the silver price up from $7 to $50 in about 3 years, and gold went from 600 to 1900 in that same time frame. But where things peaked, if you look at that low, the V right in the middle of this chart, that is a dropping of the gold to silver ratio, which in reality means that it's a spiking in the price of silver. And my view is over the next 3 to 5 years, because of what I said earlier, I'm expecting a stock market crash. We have the most expensive stock market of all time, worse than 1929, worse than 2000, worse than '08. When that finally happens, and I can't tell you when that finally happens, the rush to gold and silver will have a very similar reaction in the gold to silver ratio. It'll just basically spike downward and will at least return to this 30 to 1. Now, the average historically is 15 to 1. Now, of course, that's over thousands of years. It's been time below there. Like in ancient Egypt, we had a 2 to 1 ratio. Throughout various points in history, you've had single digits or low double digits, but historically, the average is 15 to 1. So there is a chance. I'm not saying it's a non-zero probability. There's a chance we could go to a 15 to 1 or returning to the national or historical average, pardon me, for the gold to silver ratio, but I'm at least expecting a 30 to 1. Now we could shoot below that. Now, what does that mean in terms of where the price of silver could go? To put it into perspective, I've shared many times on this channel, I think we are going to something like $10,000 gold by 2019, or sorry, by 2030. Now, in 2030, for gold to get to 10,000, it only has to do a little more than a double. Frankly, the price of gold is actually more than doubled just in the last 18 months. So I think I'm erring on the side of caution, suggesting it only does that one more time over the next 4 or 5 years. Now, if we go back to a 30 to 1 ratio and gold's at 10,000, well, then it means like $300 silver. Okay. And I've again shared that target on this channel before. That's why I believe that we're destined for those types of numbers. A return to a 30 to 1 in the GSR, $10,000 gold, probably on the low end, and that would imply $300 silver. So the real price of silver, though, could end up much, much higher than that, considering we've got 4 to 1 physical availability for investors to put into bullion. You've got an 8 to 1 mining supply ratio, and they occur in the Earth's crust at about a 16 to 1. And so, what I would call the current setup in silver, even though the price is much higher than it was last year, what I would say we have in the silver market is what's called an asymmetrical bet. It's an asymmetrical bet because the current price ratio of 83 to 1 is just so far offside from what the actual reality and scarcity and critical availability and functionality of silver is to the world, right? We know it's a critical asset that's being stockpiled by Russia, China, India, and now the US since August. We probably, obviously hindsight will be 2020. We won't really know where it'll go, but it suggests to me that something's wrong. Either the price needs to go up a lot, or there needs to be a lot more silver available to the public, which there's not. And so again, I'd say what's happened over the last couple of weeks, silver tagging 54 and then coming down today. Just gonna refresh my terminal here, tagging 47. We're just letting off a bit of steam from this major advancing phase that we've seen since the end of August. I would still look at this as a very constructive, very natural pullback and consolidation. What we need is for the price to just retest some breakout levels, reset sentiment, reset momentum. And once we do that, we'll probably be ready for another advancing phase. And it might be end of the year, might be going into Christmas. We often do see a Christmas rally for the metals. But right now, I would just say treat the pullback and the consolidative phase that we're in as a great time to reallocate. Now, it could go a little bit lower, but my expectations more or less just sideways or down slightly for the next couple of weeks. Let's call it 2, 4, maybe 6 weeks. Okay, so we covered a little bit on AI, covered the gold to silver ratio. We covered the actual scarcity and what that could imply for the price of silver. Now, nothing's guaranteed. We've got to take this market in stride. But if you don't yet have a core position of physical precious metals, this would be the time to do so. We're off the highs from a couple weeks ago. Nothing's changed in terms of the long-term fundamental thesis for why physical gold and silver are the best way to protect your hard-earned retirement account, your hard-earned savings. The dollar's been in a in a yearly bear trend after spiking shortly after the Trump election, and I can only expect that the dollar will be devalued even more moving forward. The dollar lost 14% this year alone in terms of its relative strength to other currencies. Um, let's just figure that that probably keeps up over the next 5 years. You'd be looking at something like a 60% loss by 2030 in the purchasing power of your dollar denominated assets. Okay. We're not saying you bet the farm and go all in on metals, but everyone needs a core position of physical gold and silver. And times like these, where we've pulled back off of a very exciting high, should be the time to get in. Now, Warren Buffett and other investors talking about how cliche sentiment can be, where you can never get anyone to sell at the top and you can never get anyone to buy at the bottom. Try not to be too emotional about the ups and downs and the highs and lows. Know that this is a longer term buy and hold type of investment. This is a defensive asset, but when we're in the appropriate environment, defensive assets like physical metals actually are and have been for the last couple of years the best performing asset class and will continue to outperform. So they provide unparalleled safety, unparalleled returns, all the while holding something that has no dollar exposure, no counterparty risk, no financial system exposure, and no stock market exposure. And we're still early, right? So one of the things I hear most often on the phones with my clients and with new callers is, "Oh, I should have done this a couple years ago. I've been watching this market for years. I'm way too late." No, you're not. We're really, really not. Again, 99.5% of people are not in this space. All the precious metals exposure in American portfolios adds up to about half of 1%. Now, my guess is we get to somewhere like 3 to 5% at minimum over the next several years, but it could be something as high as in like 1980, where it was 10% globally was exposure in portfolios to physical gold. Now, mind you, that was the largest precious metal bull market of all time up until about now, I think. So with the stuff that we're seeing, don't let don't let the ups and downs and normal ebbs and flows of a market scare you. Um, we need to look at this as a longer term investment. Oh yeah, and sorry, that was my I kind of lost my train of thought there. That is where this is going, is probably 3 to 5% of total portfolio allocation from half of 1%, which is like 6 to 10 fold the current market cap, or 6 to 10 fold the current capital allocation. And we will only get to that once we have an actual stock market crash or a stock market correction. Once we do see that, and sorry, I've noted this before in past episodes, but 70% of American portfolios are allocated to US equities. And the vast majority of that's concentrated in these AI stocks that I'm talking to you about. So when we see this stuff correct, and look, we are having a, maybe the beginning of what could be an intermittent cycle low or a daily cycle low. But we really have just been on the up and up since April around Liberation Day. My guess is November could look a little bit hairy, whether it's because of earnings or global tensions, or just again like natural kind of forces of gravity finally catching up with a very, very, very overvalued market. But once that corrects in earnest, and I'm not talking about a little blip on the map like a 1 month correction, I'm talking about when we're in official bear market territory, it'll last for several years. And the realization will probably come to some faster than others. But once we do get that actual rotation on capital, or of capital en masse, meaning the popular thing to do is to buy gold to protect yourself, That's when we get to my $10,000 gold and $300 silver, and probably pretty quickly and probably fairly easily. But right now, it's still just half of 1% in people's minds or portfolios. Okay. So with that, we'll wrap up. I want to invite everyone to call us. You can talk to me. You can talk to any other of our qualified sales associates. We've got a team of about 9 or 10 of us. We're all investors. We're not salespeople. We all live and breathe this stuff. Some of us more technical than others, but all of us are dealing with new clients every day. And we would appreciate just that first call. Take that first step. Call us, give us a buzz, let us know what's got you thinking about gold and silver, and we can walk you through all the steps and how we can help you protect your wealth. Okay, so again, it's Micah signing off from Noble Gold. Give us a call, 877-646-5347, and we'll catch you again next time. Thanks, everybody. Have a great day.